Understanding inflation and deflation, what they mean for your money. Both inflation and deflation are fundamental concepts in economics that have a significant impact not just on your personal finances, but also on the economy as a whole. Understanding these phenomena is essential for grasping how they influence purchasing power, savings, and overall economic stability. What is inflation? Inflation is defined as the general increase in the total price level of goods and services over a period of time. During times of inflation, the value of money decreases, meaning that a single unit of currency can purchase fewer goods and services than it did in the past. This phenomenon is commonly measured using indices such as the Consumer Price Index, CPI, which monitors the variations in the price level of a basket of consumer goods and services. Causes of inflation. Inflation can be caused by several factors, including 1. Demand pull inflation. This occurs when the demand for goods and services exceeds their supply. When consumers are willing to pay higher prices, businesses increase prices to balance supply and demand. For example, during an economic boom, increased consumer spending can lead to higher demand for products, driving up prices. 2. Cost push inflation. This type of inflation happens when the costs of production rise, leading businesses to increase prices to maintain profit margins. Rising wages and more expensive raw materials are common causes. For instance, an increase in oil prices can lead to higher transportation costs, which businesses may pass on to consumers in the form of higher prices. 3. Built-in inflation. This occurs when workers expect rising inflation and demand higher wages to keep up with the cost of living. Businesses then raise prices to cover the higher wage costs, creating a cycle of rising wages and prices. This type of inflation can be self-perpetuating and challenging to control. Effects of inflation on the economy. Inflation can have several effects on the economy. 1. Reduced purchasing power. As prices rise, the purchasing power of money declines. Consumers can buy less with the same amount of money, which can lead to a decrease in overall consumption if wages do not keep pace with inflation. 2. Impact on savings. High inflation can erode the value of savings if the interest rates on savings accounts do not keep up with the inflation rate. For example, if inflation is at 5% and the interest rate on a savings account is only 2%, the real value of the savings decreases. 3. Increased spending and investment. Moderate inflation can encourage spending and investment as consumers and businesses seek to make purchases before prices rise further. This can stimulate economic growth and reduce unemployment rates. 4. Impact on borrowing and debt. Inflation can reduce the real burden of debt. Borrowers benefit because they repay loans with money that is worth less than when they borrowed it. This can encourage borrowing and spending, contributing to economic growth. 5. Wage price spiral. If inflation expectations become entrenched, it can lead to a wage price spiral where workers demand higher wages, leading businesses to increase prices, which in turn leads to further wage demands. This can create persistent inflationary pressures. Examples of inflation. 1. Hyperinflation in Zimbabwe. In the late 2000s, Zimbabwe experienced hyperinflation with prices doubling every few hours at its peak. This was caused by excessive money printing and led to a collapse in the value of the Zimbabwean dollar, making it nearly worthless. 2. Post-World War I Germany. The Weimar Republic experienced hyperinflation in the early 1920s, with prices rising dramatically. This was primarily due to reparations payments and excessive money printing. People needed wheelbarrows of money to buy basic goods, and the economic instability contributed to political upheaval. 3. 1970s stagflation in the U.S. The U.S. experienced stagflation in the 1970s, a period of high inflation combined with high unemployment and stagnant economic growth. This was partly due to oil price shocks and accommodative monetary policy. The term stagflation was coined to describe this unusual combination of economic conditions. What is deflation? Deflation is the opposite of inflation and refers to a significant decrease in the general price level of goods and services. During deflation, the value of money increases, meaning that each unit of currency can purchase more than it did in the past. This phenomenon is also measured using indices like the CPI, but it tracks price decreases instead of increases. Causes of deflation. Deflation can be caused by several factors, including 1. Decrease in aggregate demand. A decline in overall demand for goods and services can lead to deflation. This can be due to economic recessions, reduced consumer spending, or overproduction. For example, during the Great Depression, falling consumer confidence and spending led to a significant drop in demand, causing deflation. 2. Increased productivity. Advances in technology and increases in productivity can lead to lower production costs, which can result in lower prices for consumers. While this can be beneficial, it leads to widespread price declines. It can create deflationary pressures. 3. Debt deflation. When debt levels are high, consumers and businesses may cut back on spending to pay down debt, leading to reduced demand and lower prices. This can create a deflationary spiral, where falling prices increase the real burden of debt, leading to further spending cuts and price declines. Effects of deflation on the economy. Deflation can have several detrimental effects on the economy. 1. Delayed consumption. When prices are falling, consumers may delay purchases in anticipation of even lower prices in the future. This can reduce overall demand, leading to lower economic growth and higher unemployment. 2. Increased debt burden. Deflation increases the real value of debt, making it more difficult for borrowers to repay their loans. This can lead to higher default rates and financial instability. 3. Lower profits and wages. Businesses may lower prices to attract customers, but this can reduce profit margins. To cut costs, businesses may reduce wages or lay off workers, leading to higher unemployment and further reductions in demand. 4. Economic stagnation. Prolonged deflation can lead to a vicious cycle of reduced spending, lower production, and increased unemployment, resulting in economic stagnation. This can be challenging to reverse and may require significant policy intervention. Examples of deflation. 1. The Great Depression. The most notable example of deflation occurred during the Great Depression of the 1930s. Prices fell sharply, and the economy experienced severe contraction. Deflationary pressures were exacerbated by a collapse in demand, leading to widespread unemployment and economic hardship. 2. Japan's lost decade. In the 1990s, Japan experienced a period of deflation known as the lost decade. After a real estate bubble burst, prices began to fall and the economy stagnated. Despite efforts by the Bank of Japan to stimulate the economy, deflation persisted for years, hindering economic growth. 3. 2008 financial crisis. During the global financial crisis of 2008, many countries experienced deflationary pressures as demand plummeted and financial markets collapsed. Central banks around the world implemented aggressive monetary policies to prevent a deflationary spiral. Monetary policy and inflation/deflation. Central banks play a crucial role in managing inflation and deflation through monetary policy. They use various tools such as interest rates and open market operations to control these economic phenomena. Combating inflation. 1. Raising interest rates. To counteract rising inflation, central banks may increase interest rates. Higher interest rates make borrowing more expensive and encourage saving, which can reduce spending and slow down economic activity. For example, the Federal Reserve raised interest rates in the early 1980s to combat high inflation, leading to a period of economic recession, but ultimately bringing inflation under control. 2. Reducing money supply. Central banks can reduce the money supply through open market operations, selling government securities to absorb excess liquidity from the economy. This can help decrease inflationary pressures. 3. Fiscal policy. Governments can also implement fiscal policies to control inflation, such as reducing public spending or increasing taxes. These measures can decrease overall demand and help stabilize prices. Combating deflation. 1. Lowering interest rates. To combat deflation, central banks may lower interest rates to make borrowing cheaper, encouraging consumers and businesses to spend and invest more. This can help stimulate demand and increase economic activity. For instance, during the 2008 financial crisis, the Federal Reserve cut interest rates to near zero to encourage borrowing and spending. 2. Increasing money supply. Central banks can increase the money supply by purchasing government securities or other financial assets, a process known as quantitative easing. This injects liquidity into the economy, encouraging lending and spending. The Bank of Japan has used quantitative easing extensively to combat deflation. 3. Fiscal stimulus. Governments can implement fiscal stimulus measures such as increasing public spending on infrastructure projects or cutting taxes to boost aggregate demand. These measures can help raise prices and combat deflation. For example, during the Great Recession, many governments implemented large fiscal stimulus packages to support their economies. Inflation and deflation. Implications for personal finances. Understanding inflation and deflation is crucial for managing your personal finances. Both phenomena can significantly impact your savings, investments, and overall financial health. Inflation and personal finances. 1. Savings and investments. High inflation can erode the real value of savings if the interest rates on savings accounts do not keep up with inflation. To protect against inflation, consider investing in assets that typically appreciate in value over time, such as stocks, real estate, or inflation-protected securities like Treasury Inflation-Protected Securities, TIPS. 2. Purchasing power. Inflation reduces purchasing power, meaning that you can buy less with the same amount of money. It's important to account for inflation in your financial planning and budgeting to ensure that your income keeps pace with rising prices. 3. Debt management. Inflation can be beneficial for borrowers because it reduces the real value of debt over time. Fixed-rate mortgages and other long-term loans can become easier to repay in an inflationary environment. However, it's essential to ensure that your income increases along with inflation to manage debt effectively. 4. Wage adjustments. During periods of inflation, it's crucial to seek wage increases that keep pace with rising living costs. If your wages do not increase at the same rate as inflation, your real income will decrease, affecting your standard of living. Deflation and personal finances. 1. Savings and investments. Deflation increases the real value of money, which can benefit savers. However, deflation can also lead to lower returns on investments. Consider maintaining a diversified portfolio to protect against deflationary risks. 2. Purchasing power. During deflation, purchasing power increases as prices fall. While this may seem beneficial, prolonged deflation can lead to economic stagnation and job losses, affecting your overall financial stability. 3. Debt management. Deflation increases the real burden of debt, making it more challenging to repay loans. It's crucial to manage debt carefully and avoid taking on excessive debt during deflationary periods. 4. Income stability. Deflation can lead to wage cuts and job losses. Ensure that you have an emergency fund to cover expenses in case of income instability. Diversifying income sources can also provide financial security during deflationary periods. Inflation and deflation. Historical context and lessons. Examining historical examples of inflation and deflation provides valuable insights into their causes and effects, helping us understand how to navigate these economic phenomena. Hyperinflation in Zimbabwe. Zimbabwe experienced hyperinflation in the late 2000s, with prices doubling every few hours at its peak. The primary cause was excessive money printing by the government to finance a large fiscal deficit. The value of the Zimbabwean dollar collapsed, leading to severe economic instability. People lost their savings and basic goods became unaffordable. The lesson here is that unchecked money printing and fiscal mismanagement can lead to disastrous economic consequences. The Great Depression. The Great Depression of the 1930s is a prime example of deflation's devastating effects. Following the stock market crash of 1929, consumer confidence plummeted and spending declined sharply. Prices fell, leading to a deflationary spiral where reduced spending led to lower production, higher unemployment, and further decreases in prices. The deflationary pressures exacerbated the economic downturn, resulting in widespread poverty and hardship. This period underscores the importance of maintaining consumer confidence and preventing deflationary spirals. 1970s stagflation in the United States. The 1970s in the United States saw stagflation, a combination of high inflation and high unemployment. This unusual economic situation was partly caused by oil price shocks and loose monetary policy. The simultaneous occurrence of inflation and unemployment challenged traditional economic theories and required innovative policy responses. The lesson from this period is that inflation can coexist with economic stagnation, and managing such a scenario requires careful balancing of monetary and fiscal policies. Japan's lost decade. Japan's lost decade in the 1990s followed the burst of an asset price bubble. The country experienced prolonged deflation and economic stagnation. Despite efforts by the Bank of Japan to stimulate the economy through low interest rates and quantitative easing, deflation persisted. The experience highlights the difficulties in combating deflation once it takes hold and the importance of addressing asset bubbles before they burst. Strategies to mitigate the impact of inflation and deflation. Individuals and businesses can employ various strategies to mitigate the impact of inflation and deflation on their finances. Strategies for inflation. 1. Invest in real assets. Real estate, commodities, and precious metals often retain value during inflationary periods. These assets can provide a hedge against rising prices and help preserve purchasing power. 2. Diversify investments. A diversified investment portfolio that includes stocks, bonds, and real assets can protect against inflation. Stocks and companies with pricing power and those in sectors like technology and healthcare can perform well during inflation. 3. Adjust pricing strategies. Businesses can adjust their pricing strategies to pass on increased costs to consumers. Dynamic pricing and value-based pricing can help maintain profit margins in an inflationary environment. 4. Focus on debt management. Consider locking in fixed interest rates on loans and mortgages. Inflation reduces the real burden of fixed-rate debt, making it easier to manage. Avoid taking on variable-rate debt during periods of rising inflation. Strategies for deflation. 1. Maintain cash reserves. Having cash reserves allows you to take advantage of falling prices and invest in undervalued assets. During deflation, cash increases in value, providing greater purchasing power. 2. Reduce debt. Reducing debt levels can protect against the increased real burden of debt during deflation. Prioritize paying down high-interest debt to improve financial stability. 3. Invest in high-quality bonds. High-quality government and corporate bonds can provide a safe investment during deflation. Bonds typically perform well as interest rates fall, increasing their value. 4. Diversify income streams. Diversifying income streams can provide financial security during deflationary periods. Consider freelance work, rental income, or investments in dividend-paying stocks to supplement your primary income. The role of technology and globalization. Technology and globalization have significant impacts on inflation and deflation, shaping economic trends and influencing monetary policy. Technology's impact. 1. Increased productivity. Technological advancements increase productivity, reducing production costs and potentially leading to lower prices. Automation and digitalization can drive deflationary trends by making goods and services cheaper to produce. 2. Disruptive innovations. Technology disrupts traditional industries, leading to lower prices and increased competition. For example, the rise of e-commerce platforms like Amazon has driven down retail prices, contributing to deflationary pressures. 3. Monetary policy challenges. Central banks must adapt to technological changes that affect inflation and deflation. The rapid pace of innovation requires flexible and responsive monetary policies to manage economic stability. Globalization's impact. 1. Supply chain efficiency. Globalization improves supply chain efficiency, reducing production costs and contributing to lower prices. The integration of global markets enhances competition and drives deflationary trends. 2. Labor market dynamics. Globalization affects labor markets by outsourcing jobs to countries with lower labor costs. This can lead to wage stagnation in developed economies, influencing inflation and deflation dynamics. 3. Monetary policy coordination. Globalization necessitates coordination between central banks to manage cross-border economic impacts. International monetary cooperation is crucial for addressing global inflation and deflation challenges. Conclusion. Inflation and deflation are fundamental economic concepts with far-reaching implications for personal finances and the broader economy. Inflation decreases the purchasing power of money, leading to higher prices for goods and services. Deflation, on the other hand, increases the value of money, but can lead to economic stagnation. Understanding these phenomena helps individuals and businesses navigate financial decisions and anticipate economic trends more effectively. If you found this content helpful, please consider subscribing to our channel for more in-depth discussions on economic trends and financial insights. Your support helps us continue to bring you valuable information to help you stay ahead in today's ever-changing economic environment. Thank you for watching.